In distressed situations, capital structure management shifts from value maximization to survival, creditor protection, and legal compliance. Successful outcomes require adapting theoretical frameworks, leveraging restructuring tools, navigating legal constraints, and learning from real-world cases. Understanding capital structure in distress when a company faces financial distress or bankruptcy risk. The traditional principles of capital structure balancing debt and equity for optimal value are fundamentally altered. The focus pivots to preserving liquidity, negotiating with creditors, and restructuring obligations to maximize recovery and ensure business continuity. Key theoretical adaptations in financial distress. No single theory provides a definitive framework. Decisions are highly context-dependent. The trade-off theory emphasizes reducing leverage as bankruptcy costs outweigh tax benefits. Pecking order theory suggests firms deplete internal funds, making external debt costly or forcing equity issuance or asset sales. Agency theory highlights intensified conflicts, with shareholders risking aggressive recovery strategies while creditors focus on value preservation. In the zone of insolvency, management prioritizes creditor interests, with restructuring shaped by distress severity and rescue prospects. Practical restructuring tools, SUDI-AMP mechanisms. Distressed companies utilize various restructuring tools based on creditor cooperation, legal constraints, and operational prospects. Workout agreements modify debt terms out of court, preserving value and avoiding litigation. Compositions reduce debt via partial payments but may impair creditor recovery. Extensions lengthen maturities, providing time but increasing costs. Debt-to-equity swaps lower leverage but dilute equity. New money facilities inject liquidity, often diluting claims, while DIP financing ensures operations with super-priority funding. Cramdowns impose court-approved plans, binding dissenting creditors to enable restructuring. Legal SUDI-AMP regulatory framework, navigating constraints. Navigating restructuring requires understanding in-court Chapter 11 and out-of-court options. Chapter 11 operates under the Federal Bankruptcy Code, offering tools like the automatic stay to halt creditor actions and cramdowns to bind dissenting creditors, though it is costlier and slower. Out-of-court alternatives rely on state, contract, and securities laws, offering lower costs and faster processes, but lack automatic stay protections and require high or unanimous creditor consent, limiting flexibility compared to Chapter 11's ability to comprehensively restructure the capital structure. Key legal provisions shape restructuring outcomes. The absolute priority rule ensures senior creditors are paid before juniors. DIP financing Section 364 allows super priority funding to maintain operations. Cramdown Section 1129 permits court approval of plans despite creditor objections if standards are met. Intercreditor agreements outline payment priorities, enforcement rights, and voting in multi-tranche structures. These frameworks influence negotiation dynamics, recovery prospects, and the viability of restructuring strategies. Real-world case studies, lessons from practice. General Motors 2009, a Section 363 sale moved assets to new GM, leaving liabilities in old GM. Government and unions gained equity, while unsecured creditors received a minority stake. Speed, government support, and stakeholder alignment drove success. Chrysler 2009, a Section 363 sale with government and fiat involvement preserved value. Union equity stakes and rapid asset transfers were key. Recent retail healthcare bankruptcies 2024-2025, high leverage, often from private equity, led to repeat bankruptcies. Incomplete restructurings and out-of-court liability management highlight the risks of excessive debt. Key metrics are essential for evaluating distressed capital structures. The debt-to-equity ratio highlights leverage with high ratio signaling risk and the need to reduce debt through restructuring. The interest coverage ratio reflects the ability to service debt, where low or negative values indicate distress. Liquidity ratios assess short-term solvency and cash needs, while the Altman Z-score predicts bankruptcy risk and serves as an early warning. Lastly, cash flow to debt measures the capacity to meet obligations through operations. The integrated framework for decision-making best practice employs a dynamic context-driven approach that systematically evaluates the severity of organizational distress and rescue prospects, strategically balances diverse stakeholder interests through sophisticated negotiation dynamics, carefully navigates complex legal and contractual constraints, and comprehensively assesses operational viability with restructuring options to ensure optimal organizational outcomes and sustainable successes. Distressed capital structure management prioritizes survival over optimization, using pragmatic restructuring tools based on financial realities.